Welcome to this explainer. Today, we're rolling up our sleeves and unpacking the raw balance sheet data of 7 Canadian real estate investment trusts. We're on a mission to figure out which of these are true wealth builders and which ones are just clever illusions. We are completely bypassing the shiny marketing brochures and those rosy management projections today. Instead, we're looking strictly at the cold, hard numbers. By the time we wrap up, you'll know exactly how to spot the difference between a rock-solid, reliable income stream and a ticking financial time bomb.
Now, as we dive in, I want you to keep this one central question right at the back of your mind, because what looks like a juicy, irresistible payout on the surface can sometimes be the very thing bleeding a company dry. You know, in the world of real estate investing, yield is usually the brightest, shiny object in the room. It just draws you right in. But as we'll see when we start tearing into these balance sheets, a massive yield can actually be a giant red distress signal rather than a sign of actual financial strength.
Okay, here's our roadmap for today. We're going to cover 1. The allure of yield, 2. The stable heavyweights, 3. The dangerous value traps, 4. The niche income play, 5. The deep value winner, and we'll wrap it up with 6. Our final investment verdicts.
Starting off with Section 1, the allure of yield and why we're so drawn to chasing returns.
Let's be real for a second. We look at real estate investment trusts because we want all the awesome perks of property ownership, the steady rent checks, the long-term appreciation, but without ever having to go fix a leaky roof at 2 a.m., right? It's a brilliant structure, but it creates this massive blind spot. Investors start looking exclusively at the dividend payout and completely ignore the structural integrity of the actual business generating it. Our analytical lens for today is trying to find a highly reliable 9% annual return over a 16-year horizon. We want to compound our wealth. That means we need assets that won't just pay us a nice check today, but will actually survive changing interest rates, shifting consumer habits, and economic downturns. And as the data is about to show us, chasing a high yield alone is rarely enough to guarantee that kind of success.
So let's see how this builds with our second category, the stable heavyweights, featuring RioCan and Choice Properties.
Now, these are the absolute giants of the Canadian real estate landscape. Honestly, if you live in Canada, you likely shop at their properties every single week without even realizing it. Look at these grocery and necessity-anchored behemoths. They look incredibly safe on the surface, right? They boast billions in assets and offer solid yields right around that 5% mark. Choice Properties, for example, is anchored by Loblaw, literally the definition of a reliable, defensive tenant. RioCan has shifted heavily into necessity-based retail and mixed-use urban spaces. When you look at their massive top-line revenue, over $1 billion each, they seem like the perfect sleep-at-night investments. But remember, we do not stop at the surface.
To really understand the hidden danger here, we absolutely must define the difference between FFO, which is your basic operating cash, and AFO, which subtracts the harsh, everyday reality of maintenance and capital expenditures. FFO, or funds from operations, is basically the cash coming in the front door from rent. It's a good metric to look at, but AFO, adjusted funds from operations, that is the absolute truth. It deducts the money the company literally must spend to keep its building standing. We're talking roofs, HVAC systems, repaving parking lots. You simply cannot pay a dividend with money you desperately need to fix a crumbling foundation.
Which brings us to this truly shocking number. RioCan's AFFO payout ratio is 270%, and Choice Properties sits at 166%. This means that after routine maintenance, both of these giants are distributing vastly more cash than they truly generate. I really want to let that sink in. For every single dollar of true free cash flow RioCan generates after capital expenditures, they are paying out $2.70 in dividends. Choice is paying out $1.66. So how on earth do they do this? Well, by issuing new debt or selling off assets. Operationally, they are incredibly stable businesses, for sure, but financially, these distributions are currently vastly exceeding their true free cash flow.
Okay, moving on to Section 3, the dangerous value traps. Enter H&R, Innovalis, and Ravelin.
If those heavyweights we just looked at have some hidden cracks, this next group has massive structural sinkholes. We are completely stepping out of the defensive grocery aisles now and heading straight into the distressed corners of the market. Take Ravelin's current ratio of 0.03. Now, a healthy current ratio is usually at least 1.0. At 0.03, this brilliantly illustrates the danger. They have virtually zero liquid assets to cover their near-term obligations. They're essentially running on financial fumes. Yes, they have over $185 million in revenue, so the physical properties exist and tenants are paying rent, but their balance sheet is in a state of absolute critical failure.
Ravelin has effectively been wiped out by leverage.
This leaves their equity holders with a negative book value of negative 36 cents, completely transforming the stock into a highly speculative, distressed asset with suspended dividends. Think about that scale for a second. 1.13 times $1 billion in debt, and the entire stock market values the company's equity at just $2 million. The creditors basically own this company in everything but name. If you buy this stock for pennies, hoping for some massive rebound, you are not investing in real estate, you are gambling on a miraculous debt restructuring.
And honestly, Innovalis and H&R really aren't doing much better. They're suffering from collapsing revenues, massive property write-downs, and totally unsustainable metrics that make their cheap share prices a complete illusion. Innovalis is watching its revenue fall right off a cliff, down over 37%, all while running a deeply negative operating margin. Meanwhile, H&R REIT has taken nearly $1 billion, almost $1 billion, in non-cash write-downs, which is largely driven by the structural decline in demand for their office portfolio. Listen, the market is not mispricing these assets. It is correctly pricing in their severe distress.
All right, let's step out of the distressed basement for a minute. Section 4, the niche income play, automotive properties.
This is where real estate gets pretty creative. Instead of shopping malls or apartment buildings, Automotive Properties REIT literally only does one thing: car dealerships. And they operate exclusively using triple net leases. This is huge because it shifts all the operating costs, maintenance, taxes, insurance, right over to the tenant. That creates a highly reliable 7.1% dividend yield, safely covered by 65.6% AFFO payout ratio. It is a beautiful business model for generating income. Because it's a triple net lease, if the roof leaks at the local Honda dealership, the dealership pays to fix it, not the REIT. That is exactly why their operating margins are an incredible 78.4%. Plus, car dealerships rarely pack up and move. The switching costs and regulatory hurdles are an absolute nightmare. So these tenants are incredibly sticky.
But there's always a but, right? We absolutely cannot ignore the hidden leverage risks going on here. Their growth relies heavily on external debt rather than internal compounding. Because they pay out so much of their cash to investors as dividends, they just don't have a whole lot left over in the bank to go buy new properties. So when they want to grow, they have to borrow. Their total debt is staring down their total equity. What does this mean for us? Well, it makes them a very stable income vehicle for sure, but definitely not a high-growth compounding machine over our 16-year horizon.
Now we arrive at the crown jewel of our analysis. Section 5, the deep value winner, Morguard.
Morguard North American Residential REIT is absolutely fascinating, and that's because of the sheer massive disconnect between what the company physically owns and how the stock market is currently pricing it. What's truly staggering here is the 61.4% discount to its net asset value. This means the market is essentially valuing its highly stable, essential multifamily residential properties at less than half of their actual worth. They own apartment buildings across North America, and let's face it, people are always going to need a place to live, making this an incredibly defensive, necessity-based asset. Yet you could basically buy these assets through this REIT right now for pennies on the dollar compared to what the actual physical buildings are worth. It's wild.
Now, while its relatively high debt of $2.07 billion does create a bit of earnings volatility, its very safe 46.2% payout ratio makes this a classic Peter Lynch-style slow grower, just absolutely packed with deep embedded value. The market is definitely punishing Morguard a bit because of that debt load. But look at that payout ratio again, 46.2%. Think back to RioCan earlier, paying out 270% of its cash flow. In stark contrast, Morguard is retaining over half of its true cash flow after maintenance to actively pay down debt or reinvest in the business. No, it's not some flashy tech stock, but it is a heavily discounted, highly functional asset.
All right, let's bring this all together. Section 6, final investment verdicts.
Let's synthesize all this dense financial data we just unpacked and grade it against our long-term 9% return goal. We've looked at the heavily indebted giants, the downright terrifying value traps, the smart niche dealership model, and the deep value residential play. As you can see, automotive takes the crown for safe-ish income. Morguard wins heavily on deep value, while Ravelin and Innovalis, they must be avoided at all costs if you want to protect your capital. If you just want a reliable dividend, Automotive Properties is a really solid hold, especially if you can accumulate units below $10.50. Morguard is the clear buy for long-term compounding, given that massive discount to its net asset value. Choice and RioCan, they're holds, but you really have to watch those giant payout ratios with extreme caution. And Ravelin, Innovalis, and H&R are just toxic to your portfolio right now. Avoid them entirely.
So I leave you with this final, critical thought to chew on before you ever go chasing a high real estate yield again. Do you actually know what's hiding in your REIT's balance sheet?
We've seen today that a seemingly safe 5% yield can be completely uncovered by actual free cash flow, and a stock trading at absolute pennies can still be wildly overvalued if the delboat is large enough. The numbers simply do not lie, but you really have to know where to look. Thank you so much for joining me on this explainer as we deep dive through these balance sheets. Keep asking those hard questions, and happy investing.